Welcome to The Explainer. Today, we are cracking open the world of mutual funds, one of the smartest ways for Indians to build wealth. Whether you're a complete beginner or just want to get sharper with your investments, you're in the right place. Let's dive right in.
Okay, look at this number. 61 lakh crore rupees. That is the absolutely staggering amount that Indians have invested in mutual funds as of June 2024. This isn't just some small trend, you guys. This is a full-blown financial revolution. And this quote from Neil Borate over at Mint just hits the nail on the head. It perfectly sums up what's happening. Mutual funds are no longer just a big city urban elite thing. No way. They've gone mainstream, becoming a real path to wealth for millions of people all across the country. So, let's think of this as your personal driver's manual. Mutual funds are the vehicle, and we're here to give you the keys, show you the dashboard, and help you get behind the wheel feeling confident about where you're going.
So, who's actually driving this boom? Well, it's millennials. By a long shot. Look at this. A full 50% of new investors are between 27 and 32. This isn't your parents' old way of saving anymore. A whole new generation is taking control and actively building their own financial future. So, the big question is, where do you even start? Your very first decision is choosing an investment path. So let's break down the two main roads you can take, active and passive, and figure out which one is the right fit for you.
Okay, on one side, you've got active funds. Think of this like hiring a pro driver. You have a fund manager who is actively trying to pick the best stocks to beat the market. But that expertise costs you a bit more in fees, or what's called an expense ratio. On the other side, you've got passive funds. These are way simpler. They don't try to beat the market. They just try to be the market by mirroring an index like the Nifty or Sensex. No active manager means, you guessed it, much lower fees. So the choice is really yours. Do you want to pay more for a chance at beating the market, or do you prefer the simple, low-cost approach?
Now, this little chart here, this is your roadmap. It's super simple. Just find how long you want to invest your tenure on the left and match it with how much risk you're comfortable with. So if you're only investing for about a year and you don't want a lot of risk, liquid funds are probably your best bet. But if you're saving for a goal that's, say, 7 or more years away, and you're okay with the market's ups and downs, then you'd be looking at equity funds. It's all about matching the fund to your personal goals and your timeline.
All right, now that you know how to pick a fund, let's talk about something just as crucial: what not to do. Seriously, knowing about these common investor traps is your best defense. This is how you protect your money from costly mistakes. And here it is, the big one. We have all seen those ads, right? The #1 performing fund of last year. It is so tempting to just pour your money into whatever did best recently. But should you? Is that actually a smart move?
The data couldn't be clearer. Absolutely not. Get this. Only 1 out of every 5 top-performing funds manages to stay in that top group over the next 5 years. Chasing past performance is literally like trying to drive a car forward while only looking in the rearview mirror. It's a terrible strategy that almost never works out. So why on earth do we keep falling for this trap? Well, Dr. Rachanabad nails it here. Our brains take a mental shortcut. We see a fund doing great, and we just assume that hot streak is going to continue. We think its recent performance is representative of its future. But investing isn't like that. What happened yesterday has very little to do with what will happen tomorrow.
And here are 2 other big mental traps. First, overconfidence. Thinking you're a genius, you can always pick the winners, which usually just means you end up taking way too much risk. And second, and this one is a silent wealth killer, ignoring fees. Those seemingly small percentages add up massively over time, creating a permanent drag on your money that you can never get back.
Okay, enough of what can go wrong. Let's get into the good stuff. Let's talk about the smarter ways to invest. The practical, simple tips that will actually help you build wealth efficiently and with discipline.
First up, how do you actually hold your mutual funds? You basically have 2 choices. You can use a demat account, which is what you'd use for stocks, and it lets you see your fund value in real time. Or you can get a statement of account, or SOA, directly from the fund company itself. Honestly, for most long-term investors, the SOA is simpler, often has lower fees, and makes things like setting up automated withdrawals down the road way easier. All right, time to bust another classic myth that investors love to overthink. Your SIP, or your systematic investment plan. Is there a magic date of the month to invest that will get you better returns? The 1st, the 15th, the 28th?
The answer is a big, resounding no. It just doesn't matter. The research is clear. The specific date you pick has almost zero impact on your long-term returns. So stop stressing about it. The most important thing is being consistent. Just pick a date that works for you, maybe a day or two after you get paid, set it on autopilot, and forget it.
Okay, next up in our myth-busting series, what about how often you invest? Is a daily SIP better than a weekly one? And is a weekly one better than a simple monthly one? Do you get an edge by investing more frequently? And once again, the answer is nope. The difference in your final return after many years is negligible. It's so tiny, it's not even worth thinking about. A simple monthly SIP gives you all the benefits without the headache of managing tons of transactions. Just keep it simple. Remember, discipline always beats complexity. Okay, we've arrived at the single most important part of this entire explainer. If you only remember one thing, please let it be this. This is the one idea that can literally change your financial future. The incredible, almost magical power of starting early. And to really understand that power, let's ask a very direct question. Let's get real. What is the actual, tangible, rupee for rupee cost of waiting? How much does procrastination really cost you? Just look at this chart. It tells the whole story. Let's say your goal is to have 10 crore rupees by the time you're 60. If you start at age 20, you need to invest about 8,500 rupees a month. Okay, doable. But what if you wait just 10 years and start at 30? That amount more than triples to 28,000 a month. And if you wait until you're 40, you have to invest a massive 1 lakh rupees every single month. That's the power of compounding. Time, not timing, is your greatest asset. Now, starting early is absolutely critical, but your job isn't done. As Maureen Agarwal wisely advises here, you have to check in on your investments. A quick review once a year is perfect. It's not about panicking or making constant changes. It's just about making sure you're still on track to hit your goals. Think of it as a quick annual health checkup for your money.
So if you take one single thing away from all of this, let it be this simple truth. Time in the market will always be trying to time the market. The power of compounding is the most powerful force on your side. You know that saying, the best time to plant a tree was 20 years ago? Well, the next best time is right now, today. So what are you waiting for?